From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning and welcome to another episode of the Macrocast. I'm your host today, Brian DeAngelis, a partner here at Penta, and I'm joined by my colleague Ilan Moy, who will be co-hosting today and soon taking over reins as the full host of the Macrocast with our partners, as always, and co-hosts Brendan Walsh and John Fagan from Markets Policy Partners. I also have my colleague here, Oliver Edelman. Oliver's a director on our team, runs our economic sentiment index work, and I guess has been a guest a few times on the show. So he's back here today to talk a little bit about the consumer as we dive into another week of a quasi-financial crisis. Or hopefully not a financial crisis. Hopefully this week kind of like stemmed things down a little bit. But I want to dive into all of that. Silicon Valley Bank, how DC's responding, what we see from the Fed, and especially what we expect to see next week with the Fed. So why don't I open it up? John, why don't you kick us off? What are we seeing this week in terms of kind of the reaction to Silicon Valley Bank? And then Ilan, I'd love to get your thoughts as well here on what we saw, especially the last couple of days with the banks stepping in on First Republic and some other issues. But John, happy St. Patrick's Day. Tell us what's going on this week.
Yeah, happy St. Patrick's Day. I think maybe we all need a drink of your choice after this kind of week. Tea for soothing tea for some, and other beverages for others. So we really has been a back and forth week. We obviously saw the dramatic announcements over the weekend it's seeking to backstop the depositors in Silicon Valley Bank, but zeroing out the equity and debt as Silicon Valley Bank declared bankruptcy this morning. And so the idea would basically be that this was also accompanied, of course, by the Fed's new banking liquidity backstop, which provides essentially funding for high quality assets like agencies and treasuries at par, very importantly, because this is really stemming from Silicon Valley Bank's losses in the duration portion of its treasury holdings. It's a little bit esoteric, but this was not about its loans going bad, which is the typical banking crisis. So this is something that the Fed took on head on, and U.S. authorities took head on with this new Fed facility, plus enhanced access to the discount window. You know, that is the kind of thing that can nip a crisis like this in the bud. And we saw some pretty encouraging price action. But at the same time, there was a European aspect to it, very different than Silicon Valley Bank. But we got that coming in midweek with Credit Suisse beginning to teeter, and the support from its top equity holder, really declining, and so it really has been a back and forth week, and investors are grappling with, how to assess the risks on a going forward basis. Whether this is whether the structural and acute phase, the systemic risk phase has been addressed, and whether we're into an earnings and profitability risk. That's a very important dynamic distinction to make, and so it's been a very confusing back and forth week, and markets have opened up this morning on a very tentative footing, trying to digest all the latest moves to shore up some of Silicon Valley Bank's peers, like First Republic Bank. Right. They were the recipients of $30 billion in deposits from 11 different U.S. banks, including some of the mega banks overnight. That was obviously, midwifed by the Treasury, Fed, and FDIC and OCC. This is a very fast-moving dynamic, and it really is, a very fluid situation at the markets level and in fundamentals. So to make things more exciting, we have the Fed decision next week.
Yes,
if it weren't enough.
Yeah, we'll definitely jump into that. I mean, you said a word there that I really think captures it, which is it's just been a very confusing week. Obviously a big kind of like crisis of confidence, but it seems like we've seen both regulators and industry respond pretty quickly. Ilan, I wanted to get your thoughts, especially around First Republic. Is this the right reaction and we've got this under control, or you get the sense that this might be Band-Aids as we continue to kind of fight this in the next week?
Well, I think what's interesting is that the big fear amongst the markets, amongst regulators, and obviously the public as well, is that Silicon Valley Bank would not be the last to fall. And over the last weekend, what we saw was that federal regulators and the Biden administration tried to find a buyer for Silicon Valley Bank. Nobody stepped up. But yet, when you saw the potential contagion effects around First Republic, we see the mega banks, leaping into action and shoring up its deposits in order to make sure that the fears around a potential banking collapse don't start to infect the broader sector. And I wonder, and this is just my own personal speculation, if some of the volatility that we've seen around Credit Suisse has gotten them a little bit scared and made them realize that, even if these things may not be structurally or fundamentally connected, just the sentiment amongst consumers can be enough to bring a bank down, and they don't want to have that vulnerability within the banking system.
Mm-hmm. I would add too, just on that the First Republic point, that although Yellen was involved in those conversations, the banks did this on their own. There was no, as reporting indicated, there was no under the table kind of wink and nod from regulators. There was no explicit benefit to the banks that did this.
There was no being locked in a conference room like 2008 and no one comes out until they agree to this. Yeah.
Just on the point of reactions to the First Republic or to the Silicon Valley piece and the Signature Bank piece, I thought it was interesting. We saw folks clamoring before the weekend for regulators to step in. But the reaction coming out of it has actually been kind of mixed, especially among folks that you are kind of sitting in similar seats. So, obviously you had folks like Larry Summers come out and say, this was the right decision. You had, though, on the other side of the spectrum, folks like Ken Griffin, the CEO of Citadel, saying, this was an opportunity to show that, moral hazard still matters. Right. This is an opportunity to show that capitalism still exists. And I think he basically said, capitalism is over, which is, I think, an interesting perspective.
Yeah, I think there's an existential question here, which is, does the fact that Silicon Valley Bank was essentially bailed out by the federal government, does that mean that that every bank is essentially too big to fail? I mean, this was supposed to be something that only affected the largest of the large. This is why they set the threshold for banks that have more strict supervision at $250 billion. Even though Silicon Valley Bank fell under that threshold, it's still essentially benefiting from the government's backstop. So is there any bank that isn't too big to fail?
They went into the weekend thinking this was just a normal bank failure. They'd either find a buyer for it or, take it over. It wouldn't be a big deal. But this is kind of the first time a big bank has failed in the social media time.
Yes.
Oh, wait, we weren't there yet, And I think, Twitter and Facebook started a bank run over the weekend, and the Fed had to deal with it. But I don't think going into the weekend that was on their radar. But it's certainly going to have to be on their radar going forward from now on.
Yeah, I think that's right. And you opened up the debate on the $250 billion, which was, a change to Dodd-Frank back in 2018. And it struck me watching last night with the First Republic response that, yes, this is about shoring up the banking sector and, making sure there's no contagion effect. As a political guy, it also felt a little bit of me of a signal to Washington that we got this. You don't have to go change the rules again. The system's working the way the system's supposed to work. I'm curious if others had that thought, or, I still think there'll be hearings and other stuff for these guys.
Yeah, I think the question is whether hearings are enough. There was reporting this week, I think in Punchbowl around the moderate Democrats that supported that 2018 change to the statute, Mark Warner, for example, and others. And the question is whether hearings will be enough or whether they do end up going through and trying to revise that statute. I think those Democrats in rural states still stand with that 2018 revision because, in their perspective, the community banks in their rural constituencies were, at great risk before those rules were relaxed. So I think it's an open question as to whether the law changes. I think at the beginning of the week it was pretty clearly going to say we were going to think like no, it wasn't. But we've seen folks like J.D. Vance come out on the Republican side, senator from Ohio, say, well, there are some pieces, in particular that kind of $250,000 ceiling to deposit insurance, that he's actually comfortable talking about in terms of negotiating. And so I think for sure on the regulatory side, we're going to see the Fed take advantage of the powers that it currently has to kind of up enforcement. But then on the lawmaker side, it's kind of an open question.
Let's shift over to the Fed a little bit. Let's save the Powell discussion, but we haven't spent a lot of time on this podcast talking about Michael Barr, and this was really probably Barr's kind of first big test, and a pretty big test it was. I'm curious what folks think about how Barr's been reacting. Those who know Barr, whether we might see some overreaction or some other reaction. What should we expect to see out of him in the next couple weeks?
Well, I think one thing to remember is that when Barr took over as the Fed's vice chair for supervision, he was already walking into a political minefield. The reason why he has that job is because Biden's original pick, Sarah Bloom Raskin, ended up being essentially torpedoed by Senate Republicans and also by one Senator Joe Manchin over her views around climate. So already this was a position that the Senate Republicans and Congress overall have been looking at very closely as one that's going to have a lot of scrutiny. So he's walking into this minefield. He was supposed to be sort of the calm and less controversial presence. Now he has to come up with this sort of postmortem on both what happened at Silicon Valley Bank and what the Fed potentially missed. He said that's going to be out by May 1st. And his quote in the very short statement that the Fed put out about this was that we need to have humility. I think that's going to be really important because, the Fed's postmortem could also involve pointing fingers at some of his colleagues at places like the San Francisco Fed, like San Francisco Fed President Mary Daly, who was supposed to be the chief regulator for Silicon Valley Bank.
John, Brendan, I'm curious, what is kind of the street reacting to, or what are you guys seeing in terms of kind of Barr and where do they think he's going to go with some of this?
Yeah, I mean, I think that in general, it's lumped into the broader concerns about the business model for small and medium-sized banks. The likelihood of regulation is certainly perceived by Wall Street as rising, or re-regulation in this case potentially. But that's something that it's hard to tease out exactly what kind of price action is represented by those kind of concerns. When you look at like the very near term and immediate concerns, such as the cost of funding for small and medium-sized banks going higher. And, we saw First Republic, pulling their dividend last night. And so this is, the profitability of banks, even if you think they're solvent and liquid, you can still want to sell their stock because of the profit profile going forward is going to be more challenging. And, that's something that is and can be reflected in that sort of herding behavior we see in equities that can send a disturbing signal to depositors. When your bank stock is down, double-digit percentages and that sort of thing, it sends a worrisome message. But the stock declines aren't always because investors think the bank is going to fail, but they think it's because it's going to be, a lot less profitable on a going forward basis. And regulation is part of that narrative.
Yeah, fair point. Well, I think we need to jump to the big topic of what Powell and the Fed does next week with all of this. So let's take a quick break and then we'll come back and we'll jump in everyone's predictions on what we're going to see. You're listening to the Macrocast. We'll be right back.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
We're back on the Macrocast. So next week we have our Fed meetings, and we've been all over the place. I think time we recorded this podcast, consensus was around half a basis point. Now we're back to a quarter, maybe nothing. John, let me start with you. You know, this is a lot of information for Powell to stick into his brain heading into next week. How do you think he's processing everything this week, and where do you think him and the Fed are going to go when they meet on Wednesday?
We think that, obviously expectations for Fed policy have swung wildly over the past week. As you alluded to it on last Wednesday, the base case was 50 basis points at the 50 basis points hike at the March meeting, reaccelerating from the 25 basis points downshift in February.
Where Powell was on Capitol Hill testifying in front of the House and Senate,
yes.
Banking committee.
Yes, and just a torrent through sort of the early part of March, before the blackout period, before the meeting, of very hawkish Fed commentary, and the base case really had centered around that higher peak rates. Some perhaps going as high as 6%, but Fed fund futures were up at 5.5% and potentially higher, leaning higher for that top rate. Just for context, it's 4.75% is the top of the corridor now, and so that was a very hawkish dynamic, and that has completely evaporated. The base case, as you said, is for the Fed to stay at 25 basis points, a hike next week, but with some very unclear guidance as to what's coming next. The Fed fund futures markets are expecting the Fed to basically top out here at after one more 25 basis point rate hike. Maybe they can sneak another one in, but essentially rate cuts are notably showing up in the reflected odds of Fed fund futures as early as the July meeting. And then at the end of the year, coming into this show, I checked. Last I checked, the Fed fund futures were around like 4.25% at year end is the base case, and that's below. Obviously, for those of you playing at home, that's
way
50
below,
basis
John,
points below where we are now,
John,
which is a very glum outlook.
Yeah, I was kind of confused by how far forward the rate cut expectations have moved. Do you think that's a signal that investors feel that there's more to come in terms of the banking crisis and the fallout, or do you think it's a sign that they feel that inflation is going to somehow start dropping, or that the Fed is simply going to lose its will? I mean, what is really driving that? A rate cut as soon as the summer feels really early.
Yeah, I think it really is the darkening of the financial outlook. The economic outlook that is a consequence of this kind of shock tightening of financial conditions that we're undergoing right now. Base case was, perhaps a recession later this year. But I think, whether you were more bullish or more bearish on the economic outlook, everybody is reset to a gloomier level, and certainly the idea that the Fed would capitulate in the face of falling U.S. growth, which would presumably be accompanied by rapid cooling of inflation, is what the market appears to be expecting. Now, the Federal Reserve, the European Central Bank, hiked 50 basis points yesterday and made a very clear distinction between financial stability activities and monetary policy. Monetary policy still being in inflation fighting mode, financial stability measures to shore up the banking sector, and those two should be divided. We expect something similar in the way that the Fed communicates next week, but obviously with flagging the potential risks, downside risks, enhanced downside risks to the economy from this banking turmoil episode. We certainly expect them to acknowledge that and react to it going forward. Personally, Brendan and I are very skeptical about whether the Fed can really pirouette or wants to pirouette that quickly or can pirouette that quickly into rate cuts, given where inflation is these days.
Yeah, it's a really fair point. Oliver, let me bring you in here, because some of the stuff John was talking about in terms of just the, economic conditions out there, we are starting to see, the Fed's policy really start to hit the consumer? What are you seeing in some of your research and data?
Yeah, so we saw a few indicators come out this week that support what John was talking about in terms of a gloomier outlook. So our economic sentiment index came out this week. It fell. 4 of the 5 indicators fell, and confidence in the overall U.S. economy dropped by 2.9 points, which is the biggest single reading drop since June of 2022. So that's the biggest drop in, 8 months or so.
Yeah.
We saw other indicators come out as well. So February retail sales were down after surprisingly being up in January. Orders for machinery and appliances were down, and Visa came out with its updated economic outlook yesterday. Predicting a recession towards the middle part of this year, but in particular a recession around that impacts some industries and some regions more than others. So they specified tech and manufacturing as being 2 areas that would be harder hit than others. And I think something that you all have talked about on the Macrocast time and again is that there are kind of parallel economies going on, and that if a layman were to ask, we've seen the Fed up rates again and again and again, yet the labor market remains tight. The economic signals are mixed. This recession everyone is talking about seems to never really be coming. What is the impact of these rate hikes actually, if we're seeing these overall kind of positive or mixed macro indicators? And I think just looking sector by sector, if you ask someone in tech, when is the recession going to come? They'd probably say it's here. Right. There's layoffs. There's like bank failures. That industry is feeling it already. And crypto is kind of wiped out. And so going back to the purpose of the rate hikes, the Fed said we want to kind of remove some of this froth and so forth. I think the froth is like pretty far removed in some places already. Yeah,
I think that's right. And maybe this is a overly simple question, but we've spent so much time on this podcast talking about a soft landing. It's starting to feel like a little bit of a crash landing, and not a hard crash. We're not in a hard recession yet. We're still seeing a really hot jobs market, but it's getting a little bumpy here as the Fed starts to wind down.
But another thing to keep in mind is, we don't think we're in a banking crisis,
right?
And what they're doing will help shore things up. But because of what's happening, small and medium-sized banks are going to pull back on lending just because the outlook is very unclear. They know their cost of capital is going up. They don't know what's going to happen on the regulatory side. So we're going to see less C&I lending, and especially the small banks. That's who small businesses get loans from. So a lot of what's been going very well in the U.S. economy is kind of the startups and small businesses, and that's where all the hiring has been coming from. And it's going to be harder to get loans. So that's going to very much slow down the economy, and it will be deflationary also. And that's going to take a little time to trickle through the economy, but it's going to happen no matter what the Fed does with rates.
Yeah. And we'll see what actually happens. But if you believe some of the media, you're going to see some of those small businesses flock, I think, to the big banks. We've got some big policy issues coming up on the horizon around Basel III and other issues. Like, we're going to see a lot that starts to tighten up lending and tighten up the economy across the board.
Yeah. The other thing is in terms of confluence of factors, SNAP benefits are, I think, reduced by a third beginning this month. So we'll see that kind of play out maybe in the retail side. And Brian, to your point about funds flowing to the bigger banks, there was a kind of testy exchange between Senator Lankford from Oklahoma and Janet Yellen around this in terms of the response in terms of ensuring all deposits versus just ensuring those deposits at Signature and Silicon Valley Bank. And Senator Lankford, concerned that this is going to have depositors kind of thinking about, is my bank kind of de facto systemically significant, even though it's kind of not on the front end? And does that mean I need to pull my deposits out of my bank if I'm at a small bank and move it to that JP Morgan or Wells Fargo? So I think it's interesting to see what's going to play out there. I think we saw Bank of America announce they have $15 billion in increased deposits over the past few days. And we're just going to kind of continue to see this play out. And then, back to that political argument. it's kind of the question of when do we pull trigger in terms of jumping on the populist bandwagon? I think, are people waiting for the next Tea Party and Occupy Wall Street? Does it all kind of play out again? And at what point do we start kind of politically attacking each other over this? So, yeah.
I think it's going to be really hard for those moderate Dems that you mentioned earlier, Oliver, to change their vote from what they cast back in 2018. I think there was something like 14 or so, maybe a dozen or so Democrats who initially voted for increasing that threshold for a tighter supervision, including people like Senator Coons, who is a very close ally of President Biden. So
the whole process was pretty bipartisan.
It was. I mean, all the Democrat, all the people who voted against it, senators who voted against it, were Democrats, but there were a significant number that voted for it. So I think that, even just 5 years later, it might be tough for them to take a different stance there. But there is also another emerging argument around Silicon Valley Bank, which I thought was interesting and is bipartisan, is this idea of sort of concentration of risk, and that was it a problem, or should it have been a problem or a flag for bank examiners that so much of Silicon Valley's deposits were held in one industry sector? Mm-hmm. And is that something that should be that regulators should consider more as more of a priority going forward? I don't know how bank examiners look at that. Maybe John or Brendan, you guys do, but is that something that should be added to the slate when looking at a bank's books?
Well, it's hard, especially for the small banks. Like if you're an Iowa bank, you bank farmers, so most banks actually do have very concentrated portfolios and customers just because they live in a very specific region. For small banks, that's the whole point of a small bank.
Yeah, and those banks are then generally not systemically significant. But this is the kind of weird situation where this one is it was, in theory, it was both.
And it shouldn't have been systemically significant. But the world is different now.
Today, yeah, exactly.
It went under, and they couldn't get it. The world would have survived. But the reason the Fed had to do what they did was because people were pulling their deposits out of every other small bank and medium-sized bank. That's what caused what they did. Not because they were worried about the depositors of. So the political narrative is we bailed out, venture capitalists and tech. What we did was we saved every other small bank and medium-sized bank.
Yeah, you stopped the contagion. Yeah, completely. Well, we're coming up on time. Brendan, besides the big one, anything else we're looking at for next week?
Not a crazy amount of data, but we get the global PMIs, so that'll give a decent shot of what's going on in both the service and the manufacturing sectors.
Great. All right.
Obviously, the big event.
Yeah, the big one. We may have to do a special edition next Wednesday, but let's leave it there. Let's let everybody go and enjoy their St. Patrick's Day. I can't imagine anything I'd rather do but have a Guinness and listen to this podcast. So it'll be fun for everybody. But as always, thank you to John and Brendan from Markets Policy Partners, to our new host, Ilan, for another great show. Oliver, always appreciate you coming on and adding in your data and insights. Everybody, remember, please to like and subscribe wherever you listen to your podcasts. Have a fun and safe weekend, and we'll be back next week with a lot more on the Federal Reserve and everything else going on.
Thanks, Brian.
Cheers.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.